So now we're going to get into our oscillators and teach you a little bit, which might be redundant for some of you, but I want to go through, especially if you are looking at how to clean up and utilize indicators, because there's certain nuances in this course, and I definitely got to tell you, you need to go over this course every week for the first month. At least plop the CD in, go through these things, fast forward through the viewfinder, and you can go through the CD and re-heighten your education as to the patterns, and then go back and back test these methodologies yourself. Using the stochastics, and I'm impartial to stochastics, it's a momentum oscillator pretty much. It's also called a range-based oscillator. One of the things about that is that most people think that when the market's under 20%, they go long. When it's over 80%, they go short. In a trending market condition, stochastics will kill you. But more importantly, if you know these rules right here, it doesn't matter what market condition the market's in. These rules here will keep you out of trouble. Now, what's important is understanding the rules of how to interpret buy or sell signals. When the readings in stochastics, and I use a fast stochastics, a 14 period with a 3 period average, when the readings are above 80%, once %K and %D both cross over and are pointing down, a hook sell signal is generated. But we need to wait for the market to close, and we need these values to close, cross, and confirm and lock in once they are below 80%. That's the key. You want to wait for stochastics K and D to hook, cross, and close below the 80% line. And that'll help generate a sell signal. Now, for a buy signal, you want to wait for %K and D when the reading is below 20% to both point up, cross back through each other, and the hook buy signal is generated once both values cross and close and lock in above that 20% line. At times it might be 25%, so be a little bit flexible there. But if they are under 20 and they lock and close over 20, so once again, let me repeat, if they're under 20 and then cross and lock and close above 20, that generates a buy signal. Now, using stochastics works very well in trading range-bound markets, especially when they're stuck in these channels that you can day trade out of. So once again, the market, it's up near its high. It's above 80. Market closes back beneath the 80 line, generating a sell. The market comes back, bounces, goes under 20, closes back over, comes back up. And so you can trade this market back and forth in trading ranges. But when the market closes and crosses back above that 20% line, friends, believe me, and you have what? Another high close doji. We had a doji here, but we didn't have a high close doji. In fact, we have a doji here, doesn't close higher, it closes higher there, and does it not look at closing above what? All these highs and these dojis, and you're in a stochastics hook buy mode? Buy signal. Applying your stop risk mechanism and what to follow. We see a red candle appear. Does that scare you? It shouldn't. Why? Because the market's at a pause. What scares me is once the market starts to close closer to its lows, away from the high, and we start to see lower closing lows, I'm out of the trade regardless. If you bought in on a higher closed doji, if you bought in on a high closed breakout, if you bought in on that stochastics, you're in from 129.30, you're out at 129.71. That's a 41 pip move, and look how much time you were in that trade. 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, 65, 70, 70 minutes. Not a bad trade. Now, just to let you know, there's fast stochastics and slow stochastics. I already let the cat out of the bag. I like to use fast stochastics with a 14-3 setting. The reason is I like a smaller time periods, which have the smaller that the parameters are set for any indicator, that gives you a measure of the change in price, and it's referred to the gauge and sensitivity. The larger the time periods, the less sensitive the indicator is, the fewer signals it will generate. Since I'm a momentum trader and a foreign currency trader, by all means, you are a momentum trader. You are a short-term trader in nature. So use a fast stochastics rather than a slow stochastics, and you'll capture better confirmations on trend changes and breakout moves. Now we have a couple patterns that we'll go over here: bullish and bearish, convergence and divergence. First off, we're looking at lower lows with stochastics making higher lows. That's an indication that if we are making lower lows, shouldn't the market be closing closer to the lows rather than the highs as it is in this example? In fact, that's almost representation of a true hammer formation, is it not? And what do we see ensue? The market rallying. Here's a great, the British pound. It's based on a 15-minute. Notice that we see a low here. Notice that if this is our primary low before the market rallied, and that's our low in a stochastics, notice we have a secondary low, but yet notice where the market closed. It closed back above the range of the primary low, number one. It closed way off the low. But look at the stochastics. If this market is truly bearish, after all, lower lows and lower highs means market's going down, right? Not necessarily. This is showing that there's actually hidden strength under the market. And therefore, also notice that our pivot point moving average values, they are not making lower lows. This is actually a higher value than over here. So it's hinting that the market is truly moving higher. Now these orange arrows indicate selling opportunities. The blue line represents support. Do we want to sell support? No. We want to look for buy signals. So as we see buy signals in the market, we want to take buy signals, and again, we have another doji. We have what? A high close doji, still telling you to stay with the momentum of the trade. So bullish convergence in stochastics when price makes a lower low and stochastics makes a higher low tells us that we want to look for buying opportunities in the market. Another trading pattern called bearish divergence, and it's used in identifying market tops, especially as we see weaker highs. In other words, here we have a tall green candle. Now that would be indicative of what? A benchmark candle, right? Except for after a market has been, it didn't meet our criteria or our set of rules. Remember, we talked about after a downtrend, when you see a tall green candle, that's showing us that the current flow of the market is now up. After a long rally and you get a benchmark, that indicates what? A potential exhaustion. And notice that we're at resistance, pivot point resistance line right here. Doji, low close doji, sell signal. We have a high, we have a secondary high over a primary high. Notice our stochastics is lower. Price is higher than the first peak. Stochastics is lower at the same plot in time. You see that? Therefore, we're identifying that this is probably a blow-off top. We're looking for sell signals. What type of sell signal would we look for? At pivot resistance, we find a doji. We look for a low close doji signal, close below our moving averages, crossover of the moving averages, gorgeous sell signal. Again, let's take a look at the stochastics. We see buy signals, we see sell signals, bullish divergence, high close dojis. Remember, I wanted to go over and talk about this, that sometimes we see the stochastics in the same day will give you either flat top or divergence patterns. I mean, if this is a higher high occurring here, we should have what? At least a higher high if this is truly a bullish market. We have resistance, we have a doji forming at resistance. That's bearish divergence. Why is that bearish divergence? Because our stochastics has made a look where our fuchsia colored is compared with prior highs. At this high juncture, fuchsia is up here, and we're just slightly lower. Subtle differences, but we have a flat top or a lower secondary high in our stochastics. But what the dead giveaway, friends, is you and I talked about before. Dojis form more often than not at pivot resistance. And so therefore, if we were going along this signal at support, we have a high close doji trigger. How would we manage that trade? We are in green mode, which means we're looking to go long, as our arrows indicate. We're long this trade. Our first lower close, we probably look to scale out of our position, move our stops up to break even, let it ride, but then, man, we have a thoroughly identified resistance and profit target area, and therefore we want to definitely look at getting out of that trade. So that's a perfectly executed trade in how to utilize stochastics with candles, momentum, plus our pivot lines. Now, a lot of people are very fond and familiar with the moving average, convergence, divergence. In simplest terms, it's an indicator that shows when a short-term moving average crosses over a longer-term moving average. A lot of people confuse themselves thinking, well, MACD and stochastics are momentum oscillators. It's two of the like or same indicator, and that simply is not true. In fact, the MACD is based on a moving average, and the stochastics is a true momentum oscillator. So they are two different indicators, and that's why they're great to use together. Now, using MACD in conjunction with moving average for a confirming trigger probably wouldn't be a great idea because they're like indicators, okay? You want to stay away from like indicators when you want a confirmation, such as using a MACD and a Bollinger Band. Bollinger Band, after all, is utilized off of and configured off of moving averages. So you want to use two different indicators that can help confirm each other. So that's why I like A, pivots, B, candles, C, stochastics, and then my next favorite is MACD. After that, I really don't need anything else. Now, you can use the initial calculations were a 12-period, 26-period with a smooth average signal line using a 9-period input. Those settings can be adjusted. You can tweak them yourself. I found that there really is no relevance in tweaking those. Some people, and one variation to consider is dropping the values by 1/3. Now, 3 is an important number in technical analysis and also in society. It's a Fibonacci number. They're in nursery rhymes. I mean, for gosh sakes, think about 3 in what we use. Third baseman, 3 bases, 3 blind mice, 3 sheets to the wind. I mean, we can go on and on and on and talk about how 3 in our civilization is important and the relevancy in numbers and Fibonacci ratios again. So I think by dropping the variations or the values, especially in this variation by 1/3, may help give you faster signals and it may be more sensitive to price changes. However, I don't see that, but the values would be then switched to an 8-period and then an 18-period, and for the smooth average signal line, continue to use the 9-period input. Now, MACD does react quickly to changes in the market, and that's why a lot of analysts use it, including myself. So it's considered, though, a lagging indicator based on the premise because of the fact it's a moving average value. And based on that, that's all it can state, is that it's based on moving averages, and moving averages are lagging indicators. So one of the things that we do is we help utilize the two different components, the moving average crossover features and the histogram components. Now, this is in your course book as well, but let's go over and talk about how we look for high close doji patterns. Okay, as you see here, high close patterns as we're at pivot S1 support. Notice that the market gives us a trigger to go long here. Now, it is about 1 or 2 candles later that MACD finally confirms that trigger to go long, and we have finally a zero line cross in our histogram, which is our light blue color here, and it confirms a trigger to go short the market. Our crossover feature occurs over here as well. So our system in this example, and this is based on a 5-minute with a British pound, the MACD would give you confirmation. For the most part, that's a rarity because generally the MACD is a lagging indicator. But that's how you can utilize the crossover feature with the zero line histogram, and we'll show you a little bit more about that right now. The histogram component will give you convergence and divergence setup. And what I'd like to show you now is how we utilize the more powerful signals with MACD with convergence and divergence. Now, number 1, for a bearish divergence setup, look for the number 2 point to make a higher high and the corresponding MACD signal line or histogram bars to make a lower high. Sell on confirmation for a lower closing low, and look for the MACD histogram to make lower lows or a lower peak in the moving average crossovers. That sounds confusing, but once again, we'll clear it up by visualization. Again, we're looking at a peak in price. This is a secondary peak. Obviously, it's not hard to miss. It's a secondary peak because that's our primary peak. Notice our corresponding MACD signal. Our crossover occurs here. Higher prices should have probably given us an indication, if it was truly a strong market, of a higher reading in MACD. However, the MACD reading does not make a higher high within itself of its corresponding price peaks. Our histogram component gives us a signal as the gold lines, the gold bars, make a zero line cross right here, which confirm this moving average line, which would occur the very next bar over. The unfortunate part here, if you draw a ruler up, this MACD is giving you a sell signal way down here. Notice the low close doji is giving you a sell signal to get into the market way up here. So by going short, you have confirmation by the MACD, but for those people trading just on the MACD alone, they're getting short here, and generally, if you're getting short there, you're feeling pretty good, but then you take heat, maybe you break even on the trade. I'm showing you ways to trigger entries a lot further and a lot faster in the market than most trading courses or most people are even aware. Here we have another example of MACD bearish divergence within the histogram component. Now that's the golden bars and the line set numbers. Notice that we have a higher peak value in our euro currency Forex, and this is based on a daily chart as well. But notice that our histogram is making lower lows, and notice our zero line cross finally comes over here, and that gives us a sell signal somewhere right about, if I draw that around here. So sometimes the MACD is a good confirming tool, but yet it triggers late. Let's look at bullish convergence. Now, you can read this in your course manual, and it would just be confusing, but I'll go through it on a visual approach, which I think is more effective. Number one, a doji at pivot support, more importantly, weekly support. That's pretty impressive. But notice that we do have lower lows, and a MACD has a higher low. So therefore, and we have a zero line cross confirming our trigger. Our trigger to go long on a high closed doji. Is this 3 candle pattern a more traditional morning doji star pattern? No, it really isn't, because this isn't in a really long red candle, is it? But it's more impressive because we have a secondary low, we have a higher close and a doji high, and we're at weekly support. This is a very high probability setup and a nice trade opportunity. Once again, how do we utilize MACD? Well, real simple. If we're identifying markets are at lows or making new lows or testing lows, we definitely want to see if the market truly is weak or bearish. Shouldn't the MACD or the indicators show relative weakness in the market? Is relative weakness having a higher low? No. Relative weakness would be if MACD had a lower low. So therefore, looking at just like looking at volume studies, looking at other indicators that say, what's the strength or weakness of this trend? And this downtrend was showing that it was not a very strong downtrend. It was a very weak downtrend, because if it was going to continue lower, we probably wouldn't see higher lows in the MACD. Again, same situation. Lower lows, higher lows in MACD from corresponding low to low. Again, different chart, different day, different time period, different market. This is a British pound, 15-minute, using our Genesis software, indicating a high closed doji. Notice that our green arrow triggers a buy signal on a high closed doji, thus our confirming MACD. However, MACD confirms and crosses over much later, and that's a truer representation of sometimes what can happen. Here, if you look at the high closed doji at pivot support, notice that we're getting a buy signal somewhere around 175.10, and we're getting our buy signal around 175.20, 22 level on our MACD, or close to actually 175.25 on the MACD signal. So therefore, I think it's impressive to follow how we utilize the hidden value of the high closed doji setup and how to utilize our technical studies. So hopefully if you already have a education on MACD, I'm just showing you how you can integrate it to conform with what you already know. Using these powerful setups within the marketplace will give you a better indication or clue that you can anticipate that if this is a high closed doji, I want to go long, and at that point in time, notice that, hey, wait a minute, the MACD is higher than that low. This is probably bullish divergence, and I'm going to look for this market to take off, and we should see higher highs and higher lows, and I'm going to profit from this. And guess what? You do. Great job. Now let's take a look at stochastics and MACD. I use a fast stochastics, and this is your regular setting with MACD. 12, 26, 9, and your 14, 3 setting for your fast stochastics. Now we have bearish divergence, which is reflective in what? Our stochastics. We definitely have a lower low. Stochastics has a higher low. MACD has a higher low as well. We don't have a double moving average crossover, but notice our MACD histogram finally triggers a zero line cross, which confirms an equal opposite tweezer bottom. Isn't that something? So stochastic signals in convergence in MACD, sometimes you don't get that convergence signal in the MACD, but you do in stochastics. But therefore, I think by utilizing and understanding the relationship, by not just focusing on the moving average of MACD, by focusing on the histogram, by focusing on that zero line cross, and then utilizing your stochastics, it'll help give you a better indication of a potential market move. Now we get into Fibonacci. Now Fibonacci series, and this is in your course manual as well, indicates, of course, the relative series of numbers in an infinite series that each number is added to the previous, such as 1 and 1 equals 2, 2 and 1 equals 3, 3 and 2 equals 5, and 5 and 3, 8, and so forth, and that goes on to infinity. The difference between the actual number series and the ratio of the numbers is the difference between what the ratio is between the numbers. If you think about it, 50% of 2 is 1, right? And so there's a ratio difference in between these numbers and the corresponding relationship. This is the actual portrait that Leonardo da Vinci said that from the nose to the pubic crest was exactly 618% of the overall length of the human body. So he really discovered the Fibonacci numbers in using with them. And so I think that's where we get more and more amazing results, because everything in life has to deal with these Fibonacci ratios. A lot of things, I must say. If you take your credit card out, the length is, or the height of your credit card is 618% of the length. So even just in everyday simple things, we deal with Fibonacci numbers. Fibonacci numbers are derived from the calculations within the Fibonacci series numbers, as you and I just went over with you. The most common numbers are 38%, 50%, 618, 78, 100%, 127, and 1618. Now, of the numbers, the most important is the 618, and it's called the golden ratio number due to the many coincidences that occurs. For example, you'll take 89 equals plus or minus 618 of 144. 144 divided by 233 is 618, and so forth, and so forth, and so forth. So there's a lot of relationship in mathematics and distances. And of course, we are looking at mathematics and distances of price and time in trading in the markets, and that's why people look at Fibonacci. Fibonacci analysis, it's a seminar within itself, and I find that pivot points on a longer term time frame works more times than not, and actually it's more accurate than Fibonacci is. And you can go and study this yourself. It's taken me about 20 years to figure it out, but many of my good friends who are Fibonacci experts have tried to convert me to solely using Fibonacci, and I've actually helped convert them to go back to pivot point analysis, mainly because of the fact it's easier and it's less subjective. You don't have to determine what the actual peak or trough or high or low of the market was to determine a correction or extension level. But we're going to go through that and show you what I mean by that. In a correction can last from point A to point B. Subjectivity, what's point A? Was it the first low, the second low, the bottom low? It's the low. It's not really that hard to figure out. And, of course, the highest high of the peak. So we call the bottom a trough and the top a peak. So from the trough to the peak, the market can correct back 38%, 50, 618, 78, 100. Even corrections can even take more meaning than 100% of full correction. We can go 127 and 1618 of the overall move. Here we have our traditional, if the market has a rally and we're near a pivot support and we get, lo and behold, a high close doji trigger, we take our low point to our high point, and we can determine if this market is just going into a pause or if it's going to resume the trend or reverse the trend. If the market holds, for the rule, for the most part, 50 to 618 correction and does not close below the 50 or 618 correction number, then it's probably going to expand and continue its general trend range. In other words, what I mean by that is, if this is the trend, if this is the consolidation, it's going to resume the trend. Remember, markets go in trends. They go in trend, consolidation, and in that consolidation, we don't know if they're going to resume the trend or if they're going to reverse the trend. But by looking from point A to point B, whatever that correction is, if it holds 50% to the 618% number, okay? If it holds that, generally, as it does here, 50%. Notice this low holds 50%. Then generally we're safe to assume that this market continue up. That doesn't mean that if you're long from a high close doji trigger here, you're out of harm's way. Again, notice that we had a nice buy signal here, and then the market gave a sell signal or a low close. I don't know if this market's going to go down. I don't know if this market's going to just pause and then take off. Therefore, why don't I put a stop at break even and get out of partial positions and let it figure it out later? That's why I use that type of trading approach. Besides, you can always get back in the market if you so really feel that you're missing an opportunity. And by the way, do you see this doji here? We have another buy signal here that occurs after the market hit its 50% correction. We have another high close doji that occurs and would allow you to get back into a trade anyway. So by buying in the market, by scaling out, by putting your stop at break even, if the market truly is going to continue up, you shouldn't have to worry about your stops getting hit. And besides, by scaling out, didn't you make money for the day? And the answer is yes. How do we use Fibonacci correction levels? Well, real simple. Fibonacci, we determine point A to point B, and we can use them for not only up markets, but also down markets. If the market's truly bearish, it should hold its, 50% and 618 correction levels. See this down red candle? Would that not be a benchmark? And would not the midpoint act as resistance? Notice that from the high to the low, the coincident factor is Fibonacci at the midpoint of that benchmark breakdown candle is 38%. Isn't that something? So therefore, by just using little subtle, simple techniques, you can not or remove complication from your trading approach to the market. I know that that's a benchmark breakdown candle, and I'm going to look to see if 50% of the benchmark's real body holds as resistance, and it should if the market's truly bearish, and it does. It just so happens it coincides with a Fibonacci retrace level. So rejection at the 38%, it confirms what? That sell signal in the market as well. Now what about the golden ratio, the 618? Well, you want to sell or buy 618 retracements until prices closes above or below the resistance or support level. That's the best way to trade this. So let's take a look at this. We have point A at resistance. Notice the doji. This is Australian dollar. This is a 15-minute time period. This is the Forex market. We have point B, the low as we know it at that point in time. That's the low. Look at the retrace. Market comes back to the 618 level right here. At that point in time, if this market truly is bearish, it should not close above that 618, and it doesn't. In fact, price is rejected sharply, and we continue a downtrend. So therefore, watching that 618 and watching to see where the market closes in relation to 618 is very crucial. As far as Fibonacci price objectives are concerned, using extensions, and that's what we call this, we take from point A to point B, we measure off the correction. I always say if a market is in sync with Fibonacci, it stays in sync with Fibonacci. In other words, from point A to point B, if it's in sync with Fibonacci and respects and holds a 50% correction, if the market is to advance, it's probably going to respect the Fibonacci extension ratio numbers, those extension numbers. So we want to extend from A to B, and we want to extend upwards and outwards. Most charting software, including Genesis, has the Fibonacci extension and correction tool as part of the package. So it's not something that you have to pay for an extra plugin. So therefore, if you take our target low, which is A, to our target high, which is B, and again, resistance, pivot point, I mean, we're talking doji, not hard to see that high, not hard to see the low, right? So we take from A to B, we would extend our tool upward, and guess what? An extension of AB gives us C. Is a 618 extension, and then a 200% extension of the AB move. So that'll help give you a profit target if the market expands through a pivot point resistance. So why is that important? Real simple. If I know that we're starting to see resistance and we're at a Fibonacci number, I don't need my software system to illustrate that we have a sell signal. After all, if we have a buy signal right here, which is around 118.80, and it finally triggers an exit of the trade at around 119.16, I have a nice trade. I mean, end of story. But the Fibonacci may help you to uncover the hidden resistance, and therefore you may have a game plan, because after all, it's a 15-minute bar. You've got a lot of time in here to determine what your potential profit objective is. Notice that the 618 extension held market. Even though it briefly went above it, it came right back and it stayed beneath it for an awful long time. So if you had a nice clean trade, in, out, walk away, that's the proper way of trading in the markets. How to use Fibonacci extensions to the downside? Simple. Point A being resistance, that's our first known major low, and we want to see what the move is and what our profit objective, if this market gives us a sell signal, and it does right here, as we have a low closed doji, as we see the market close below both moving average values and both moving averages cross over. What's our downside objective? By the way, this is the euro currency, another benchmark, midpoint axis resistance, and we're going to measure out where the market objective could go. 618 tool. Look at the fascination of the coincidental factor that the market stops and stalls near that 1618 extension support zone. Also, notice that the Fibonacci expansion targets the low of this whole move into the next time period. So this blue dotted line lets us know that we've gone from one trading session to another 24-hour trading session in the Forex markets. So using Fibonacci, again, it doesn't help us to determine when the market's going to get there. It only says here is a measurement. With pivot point analysis, it tells us what the potential low or the potential high is in a given time frame. Now, one of the tools that we can borrow from futures, which we went over in your course manual, but I thought I'd show you distinctly and go through that so you hear it from my voice directly, is the Commitment of Traders report. And for foreign currency trading, friends, I got news for you. It's very important that you follow some of this information, especially if you're looking at a very large degree trend, or such as if the market went into trend mode for a very long particular time, you can uncover whose hands the market is in control of. And it's kind of like legal insider information. The Commitment of Traders reports can be found for free on my first website, which is www.nationalfutures.com. Just under the header where it says Trading Tools, click on CFTC COT report, and then what you need to do is you have to identify what market each product is, which exchange it's traded on. Such as foreign currencies are trading on the Chicago Mercantile Exchange, so you want to go through the list, find the exchange, click on Chicago Mercantile Exchange, and then scroll down till you find whatever market you're looking for. And this is what the form looks like. This is in the case of the British pound. Let me show you exactly what this is. You have non-commercials. Those are professional commodity trading advisors, hedge fund managers, people that are using the futures as a hedge or speculative investment. Now, they may be in Forex. Maybe they're hedging their position in the futures. Or if they're what we call a CTA or a managed fund, they're using the futures to speculate. Once again, they're the smart money, and they're also the deep-pocketed smart money speculators. Non-commercials. That's what they're considered. The commercials are the banks, the institutions, or multi-international conglomerate corporations who are looking to hedge their risk. They know that in the next 3 months, I'm going to have to convert US dollars to euro currency, and I don't want the valuations to change. I know what it costs me today. I can work that into my business model, and I can see an answer to my shareholders at the end of the quarter that we did not take a loss on conversion. We sold a lot of product overseas, but man, when we took our profit home, we got killed on that conversion rate. So what will happen is commercials will enter in the market, and that is represented by this figure here. Now, what they do is they take what we call the open interest. The open interest is the overall contracts, either long or short, and that's also in your trading guide, by the way. And they determine between the professionals who have reportable positions and the commercials who have reportable positions. They take those figures, subtract it from the total open interest number, and they figure out that the little guy, the non-reportable position category, that's the individual speculator who might be in 1 or 2 or 10 contracts, not certainly 200 or 300 contracts, right? They distinguish what their position is. The next line, we see, of course, long, short, how many are spreading, long, short, long, short, long, short. Okay, real good. Look at this non-reportable, the small speculators. In this situation, the British pound and the Commitment of Traders report comes out on every Tuesday. So as of 5/10, which was a Tuesday, if you go back and look at your calendar, 5/10 of 05 was a Tuesday. Now, if you move forward, it's released on Friday afternoon at 2:30. Well, here's the thing. You've got to distinguish what happened from Tuesday to Friday. That's the key with using Commitment of Traders report. And if there is no big change, and if the market was in a big run-up in the market, and prices were advancing, and I see that these guys are long 2-to-1 contracts, if I see the banks and the institutions are short, and if I see the commercials, look at the non-commercials, I mean, the professional speculators, they're long 5-to-1. They're long 25,000, they're short 5,000. That's a 5-to-1 ratio. 22-to-12 is almost a 2-to-1 ratio. That means all the speculators are net long, the banks are net short. Do you see that? Here, long 40,000, short 70,000. That's how you read that. To me, I would say if I were long, I'm getting nervous. Or I'm looking for, if I have sell signals like a low closed doji, if I have bearish divergence, I'm going to probably take the advice or the opinion that I can look for selling, or I want to stay on the short side and look for selling opportunities. I don't want to buy breaks. That's how you can use this information for longer term trading. Well, let's take a look at this. By the way, right here, this arrow, that was as of Tuesday. That was what was going on in the market. There, Wednesday, Thursday, and Friday. So again, this is what the market was showing us. What was going to have happened. And sure enough, the market went down like a rock. Now, again, this is the 10th, as you see on your screen. So we know that if that's Tuesday, that's Wednesday, that's Thursday, that's Friday. Did the market conditions change? From Tuesday's close at 188.27 to Friday when we got the information, the market dropped 327 pips on a British pound. I'd have to tell you something. I don't think the public or those professional speculators are still long the market. So you can determine how to use this information and determine what the strength or weakness of the trend is and whose hands is in control of the market. This is for just identifying the trade. You only have to do this once a week. If you're only trading 2 or 3 Forex markets, it's not a lot of work. Once you identify how to look at the information, whose hands does the market is in control of? Is it the banks or the small speculators? If you're long and you see the rest of the world is long, you're probably not on the right side of the market, or it's time to get out of the trade. You've probably been in that winning trade too long. Now, the structure of setting up a trade. You gotta, and I've talked about this many times in this course, you gotta identify yourself as a trader and what the trade is and how you're gonna enter it. Are you gonna be a swing trader, a day trader? You know, and a swing trader is a trade that lasts 2 to 5 days. Is it a position trade? Once you acknowledge what your objective is and what your goals are, then you can narrow your expectations. If I know that I'm only going to be in the trade for the next 5 or 6 hours, or the U.S. session, or if I know that I have to go to work, or if I know that I can't manage the trade entirely, you know, through a lot of these trading platforms, you can obviously place stops. You can place hard stops. You know, you want, as soon as you get into a trade, especially a day trade, place a stop close only, but then managing the trade, are you going to carry it overnight? Are you going to, you know, go to work, come back, and maybe you're still in the trade. Maybe you balanced out a half your position or scaled out of a portion of your position. You've got to ask yourself, what's going to hinder your trading? What time constraints do you personally have on the market? Since Forex offers 24-hour trading, there's some great times to trade, and there's some lull times that you shouldn't trade, that you're going to see those sideways channels. Are you going to be awake to trade those, and how are you going to trade them? Using pivot points will help give you a gauge or a guide as to what the potential range might be of a given time frame, such as the month or the week, and then, of course, the day. But if you can identify what you are as a trader, you can probably grasp your expectation of what the trade will give you. So, you know, for a day trader, I generally am able to identify what the average range for the day is. And as a day trader, I probably am not going to be able to pick the bottom every time. You know, with a high close doji, with that HCD trigger to go long, I mean, you and I have seen a lot of examples. There's no way we're picking the bottom. And we're letting the market ride. We're not selling the top either. So if I miss 20% of the bottom and if I miss 20% of the top, then I can only capture maybe 60% of the average daily range. Well, what does that mean? If the average daily range is 100 pips, you're only going to get 60 pips every day if you have a good day. What if the average daily pip is only, or the average daily range is only 80 pips? Well, you can only expect that possibly 60% of that would only be around 45 to 50 pips. So you're looking for setups, you're looking for conditions, like a downtrend to reverse to go into an uptrend. You're looking for a signal to trigger to go long. That high close doji is that signal, and capturing and utilizing the MACD studies or stochastics can help confirm that entry. Now, how do you start trading? Well, first you got to open up a Forex account. Next, you obviously need to practice the platform, not just with real money. You need and practice trading. You need to practice that platform. Every platform, every company has different icons, different idiosyncrasies, and there's just different nuances within every order entry platform. So you need to get a demo account, practice, bang it up, break it. I always say that to all my students. Try to break a system. If you can't break it, you'll learn how to use it. Don't be afraid of it. Go at and use one of those demo accounts to learn how to practice the system itself for each individual brokerage firm that you deal with. Then maybe utilize a system such as what I've been teaching you and back test it yourself, and maybe go through a lot of these signals. And if you get the Genesis software, or if you are interested in my plugin, by all means, if you're interested in getting the Genesis, we'll give you a 30-day trial for it. It's not a something that's going to set you back by any stretch of the imagination. You can actually set up your own program, look for these setups yourself, and here's how you want to set up your computer, whether you're using any software out there. There's a lot of great software packages. What I use for day trading is this. I immediately set up all my charts for 5 and 15 minute. 5 is at the top, 15 is at the bottom. Now, I trade various markets. I trade futures, I trade Forex, I watch the various markets, and I use those 2 time increments for my day trading. Now, If I'm looking to hold a position as a swing trader, remember we went through this in the beginning of the presentation, about a 60-minute daily, weekly, so you want to look for those as well. Here's what my screen would look like with the Genesis Trade Navigator with my proprietary software plugin. First off, I have 5 minutes all across the top, and I have 15 minutes all across the bottom. Now, if you take a look and focus right here on the British pound, this is the spot Forex British pound. What I'm looking for is I'm looking for the market to get near resistance. I'm looking on a 5 minute to give me a sell signal. And then, as the market, as I'm in that trade, my best trade opportunity is when the 15 minute confirms the 5 minute signal. Now this, by the way, is a textbook trigger trade, and it's right off the low close doji. Enter on the close or the open. Your risk is a stop close. We take no heat on the trade. It's confirmed by a 15, and as you can see here, we see immediate results in that trade. So as far as this particular trade, the market went from approximately 178.29. Within 5, 10, 15, 20 minutes, we're at 177.84. So we have a very nice quick trade in the market, and as you can see here, we're seeing our support way down at 177.02. As a day trader, I already know what my expectations are for a profit objective. I'm going to manage the money. I've already earned this money. I'm not going to let the market take it all away. On the first signs that I'm starting to see that the market is drying up, that selling's not continuing, I'm going to scale out of some of my positions. I'm going to move stops to at least break even, and therefore I can't walk away a loser for the day. And that's the effective way of trading. One thing I got to tell you to help you to see if you're effectively following a plan, remember, human nature, we're creatures of habits. Generally, we're creatures of bad habits. You know, we try to diet, we try to lose weight, I'm guilty, we try to get better at golf, we go take lessons, the golf pro gives us drills, says don't play until you practice this at least 5 times. 2 hours later, I'm on the golf course playing golf. Right? I mean, we all have things that we're creatures of bad habit. We're on a diet. Don't eat a candy bar. Okay, then give me 3 of them. I mean, there's a lot of things in life that we try to do. Trading is no different. We're trying, most people have problems with the market is because they have this subconscious that's trying to outsmart the market. They're trying to beat the market. You're trying to beat the system. Well, you're not going to do that. And if you do it once, you're going to have a lot of issues in your trading career because your mind remembers that you did it once. You can probably do it twice, and you're going to have a very painful trading experience. So if you want to make sure that you are true to yourself and true to a system, what you do is print your charts out, track where you got in, follow that. Was it a valid signal that I got in on, or did I beat the system, and did I beat or anticipate the signal? You and I went over many times. You can't anticipate signals. It may work for you once or twice, but for the most part, you're not trading a system. You have to trade by a set of rules. Live by the set of rules, trade by the set of rules. You know, I tell people in seminars that, you know, we have these 10 commandments to live by. You may not be a religious individual. You may not be spiritual. You could be an atheist. All I know is that these commandments, you know, are just a way of living that just sets us right to our fellow man. And if you're trading and you have a set of rules, if you follow those rules, if they make sense to you, follow those rules. Don't break those rules, and you will have a very pleasant journey in your trading experience. If you track your trade and print out your charts and you mark down where you got in, mark down where you got out, you'll be able to go back to see whether you were true to your system or not. As discussed in the futures markets, a lot of our trading platforms have this features, which I'll show you. For example, this is nothing new. You know, we teach this at our trading university for a lot of our students. This is actually what you're looking at as a live trading platform from what we call Strategy Runner. And again, this is a British pound. As you see, it says CME right here, British pound. As you can see, it tells us our prices at every different level. And with trading futures, we're going to see bids, how many people are buying below the market. You can't see it, the numbers are hidden, and you can't see how many offers, but see where it says bids and asks? We know contract sizes in futures. That's what we call transparency. So the Strategy Runner feature gives us a trade out. If I'm long, I want to trade out, I just one button and I'm trading out. If I'm long and I want to immediately reverse, if I'm long 4, I want to sell 4, it'll reverse. Instead of selling 4, if you're long 4, think about it. If you sell 4, you're flat. So I need to sell 8, and then I'm reversed. I'm now short. Well, notice down here in our chart, and that's what the strategy runner, it gives me, of course, it tells me my account, what I've done. I've entered in a total of 4 contracts. It tells me my prices that I've entered in. I had limit orders to buy, and then I went market, and then it tells me with these blue dots, I had limit orders to buy. I went to go buy on the close or the open as we had this high close candle pattern. We closed above our doji. Was I true to myself? Yes. Was I true to the system? Yes. Am I making money? Yes. I'm up $637, and I'm just trading a 4 lot in the futures. It'll also tell you what your your DAX, your E-mini S&Ps, your British pound, your euro currency FX, but trading on a chart by tracking your trades, folks. You don't need to have a futures account for Forex, of course. You can utilize this on your Forex chart. Just print it out and put the blue dot in yourself. When the market gives you a reason to get out, you got out, mark it down, and then you can go back and back test and see how you perform against the market. It's as simple as that. If you have a set of rules, write them down. Put them on a post note. Put them on a 3M card. Put it on front of your computer. Write those rules down. Remember, the key to success is you've got to unlock the door to knowledge and improve your trading skills. And by buying this course and by reviewing this course, don't take the course lightly. Go over this information. It has taken me 30 years, close to 30 years, to develop these techniques. I've taught many people, and a lot of them have turned into very successful traders. I've taught a lot of educators who are now taking my methods on the road and teaching them themselves. You've heard directly from me a lot of what I teach in private seminars across the country. And I got news for you. Seminars and traveling takes a lot out on you. And my focus is in trading and money. And of course, that's what I'm doing. I'm trading money. And I use these price forecasting tools. But, just trading and using price forecasting isn't alone. It's not the only thing. But trading, it's also about good risk management. And I've given you several different clues of stop placements, what type of stops to place, where to place those stops, how to trail, scaling out features, when to get out, what to do in trading in the Forex market. So remember, trading, it's not only about price forecasting, but also good risk management and money management. And that's something I hope that each and every one of you walk away with. One other element, you're going to get bloody noses in trading. You're going to have losers. Losing trades will happen. It's all right to lose your shirts in this business. Just don't lose your pants, because that's where your wallet is. Remember, you're going to have losses. The system that we designed with Genesis software that indicates with our arrows of buy and sell is only rated at a 64.4% accuracy win-loss ratio. And that was back-tested over 3 years. It's a great win-loss ratio, but it just proves to you one thing. There's going to be losers. And if you mess things up, such as if you have, for every winner, if you win $200, and if every loss is $100, that's a heck of a system. But if you mess the system up and you know that you have 65 out of 100 trades will be winners, and you know your winners are double your losers, that's a great system to have. But let's say you randomly decide to get out of your winner too early, and you allow your losers to grow because you're afraid of getting out. You're going to mess up a system, are you not? So you got to take the signals when you get them. Don't be afraid to have losses. You will have losses. Just remember, if you're true to your system, the system will be true to you. Trading is about consistency. That's all I have. I wanted to bid you the best success in your trading career.